Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So the equity market finished at record highs today at the start of what will be a very busy week for earnings. We also have a watchful eye on the tariff story. That's because trade negotiators from the European Union and the U.S. are heading into another week of talks as they seek to close a deal by August 1st. And in a moment, we'll look at markets from the APAC perspective. We'll hear from Sean Darby. He is managing director at Mizuho Securities Asia. But we begin here in the States. Joining me now is Ed Butowsky. He is managing partner at Chapwood Investments. Ed is on the line from just outside Dallas, Texas. Ed, thank you so much for joining us. I'd like to begin with the earnings story. So far, more than 80% of the companies in the S&P 500 have beat estimates on sales and earnings for Q2. And I'm wondering whether you put a lot of stock in that, since we know that expectations have been lowered a bit.
Yeah, I do. I mean, nowadays with the oversight by the SEC on the companies and what they're able to say prior to earnings releases, they have to be pretty exact. And if they're beating them, then they're really doing a great job. I think a lot of credit belongs to the CFOs of most of these public companies because they're doing an outstanding job of bringing in really strong revenue numbers.
So I mentioned a moment ago, Ed, that we're at record highs for not only S&P, but for the NASDAQ comp as well. Is there anything that makes you a little uneasy at this point?
Well, not really. I looked at the Magnificent Seven forward PEs because I was going to put out a video message to my clients about how overpriced they were. And I could not support that. I mean, if you look at Amazon, they're selling at a forward PE of 36. And I think Amazon can hit that number. Apple is the only one out of the Magnificent Seven that doesn't look really strong, but Meta looks really strong. And, just about every one of the Magnificent Seven, which are leading the S&P, look very strong with the exception of Apple. And there's really nothing that scares me at this point, with the exception of some of the conversation going on around Powell and where Powell and his relationship with Trump is.
Well, it's interesting you make that point because today the White House was very clear that the president has no plans to fire the Fed chairman. But the rhetoric sometimes has been a little hot. Obviously, Trump would like to see lower interest rates. Do you think there is a chance that we could get a rate cut as soon as this month's meeting?
I don't think it's going to be this month, but I think next month there's a really good chance because you have to focus in on the GDP number. That's where all the attention needs to go to. Forget about inflation. That's not a problem anymore. The problem is a slow and weak U.S. economy. And the U.S. economy is the Pied Piper of the world economy. As the U.S. economy goes the rest of the world. And I think that we need to really focus in on the weak GDP number that was printed last time.
So we were talking about earnings a moment ago. Alphabet will report results this week. I think the market's going to be looking very closely at spending on artificial intelligence. How are you playing the AI story right now?
I'll tell you, I've been kind of a ninny on this, if that's the appropriate word, because Nvidia has been, the only real play other than SoundHound, SOUN, are ways, I think that AI is going to be sort of like nanotechnology. It's going to be infiltrated into companies, but making money in those companies is going to be very, very difficult. So I really believe that the AI play is going to be, Nvidia or SoundHound, or, there's a couple of others. There's GigaCloud, which is more of a tariff play at this point, but could also get into the AI world.
Speaking of tariffs, tomorrow morning before the opening bell, we're going to hear from General Motors. I mean, this company could be very much exposed to the tariff story. I mean, are there other industries that you're particularly sensitive to away from autos that you're maybe avoiding right now because of the exposure to tariffs?
Not really. I think that Trump is out there just kind of, whenever he wants to say he's going after this country or that country, I think a lot of it has to do with negotiating. And I don't think there's a lot of fear that the tariffs are going to hold and be as strong as they are. But I also believe that it's a really smart move. It's a long-term play. That's what people have to realize, is that the tariffs are a very long-term play. They're not short-term at all. And that any kind of, disruption from the tariffs is going to be short-lived, but then also very, very long-lived. So, getting these factories into a situation where they're able to produce products like they were able to do overseas. Like Nike is not coming back to the United States. Nike is going to remain doing a lot of business in Vietnam because of the low cost and the tax structure that they're able to get from Vietnam. So there's really a lot of confusion about the tariffs, and I haven't made anything more understandable, I can tell.
I think the view on the street is that we could have an effective tariff rate somewhere in the low teens. Does that feel to you like it has the ability to contribute something more to inflation beyond just a one-time bump?
Yeah, but you have to remember that the tariffs are paid for by the companies that import the goods. So if we're importing a washing machine from Mexico, Mexico is not paying that tariff.
Yes.
It's Whirlpool who's paying that tariff.
Right.
And a lot of people don't understand that. So they automatically think that the Mexican government is writing a check to the U.S. government, and that's just not happening. The retrofitting of factories is going to take quite a while. That's why I said in the short run, you're going to have a bump, but in the long run, you're going to have a lot of sensible trade going on that should have been taking place over the last 15, 20 years.
I get that, but if I'm Whirlpool and I'm worried about my margins, don't I want to pass some of that cost on to the consumer?
If you can, absolutely. You want to pass it on everywhere you can. I just don't know if you're going to be able to. And there was kind of an interesting story in Business Insider where this one company decided to go forward and produce their shower heads using all U.S. Sources versus Chinese sources. And the U.S. sources had the shower head go up to $239, and using the Chinese sources, it was $140. And they sold about 800, and they were all sourced from the Chinese government. So I don't think people are that quick and that easy to give up the profitability to be pro-American. I think Trump has that wrong.
Are you looking at opportunities offshore, or are you focused primarily on opportunities in the U.S.?
I look at my favorite stock in the world is Mercado Libre, MELI. I think that Mercado Libre is the Amazon of Latin America, and I believe that they have figured it all out, and they're going to do very, very well. They have some e-commerce business, they have some bank business, but mainly they're order something just like Amazon and have it delivered to your home. And I believe Mercado Libre is selling it around $2,300. I think it's going to go up to about $4,000 in the next year and a half.
So for clients that you deal with that may be a little more inclined to be conservative, if you had to look at the bond market right now, are you finding opportunity? And if so, at what part of the curve?
Well, I'm looking at anything that is double B and single B rated. I'm a little bit more of a risk taker in terms of total return on bonds, but I really like the BDC market, the business development company market, and the senior rate floating note market. But my favorite investments right now are utilities. I love utility stocks.
Ed, we'll leave it there. Thank you so very much for joining us. Ed Butowsky is managing partner at Chapwood Investments. He joined us on the line from just outside Dallas, Texas, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We're seeing small gains in equity trading in both Seoul and Sydney this morning, and Japan is back online after that national holiday and this week's election in the upper house. Investors are also keeping a close eye on anything tariff-related ahead of that August 1st deadline imposed by President Trump. For a closer look at market action, we heard from Sean Darby. He is managing director at Mizuho Securities Asia. Sean spoke with Bloomberg TV host Shery and Paul Allen on the Asia trade.
Sean, I want to start you off, if I can, with some of the reaction to what we're seeing in Japan. I mean, we're back trading for the first time since the election. How do you approach Japanese assets at the moment? We've got uncharacteristic inflation, tariff uncertainty, and now political uncertainty as well. What's your approach here?
Well, I think for the whole of North Asia, they're still under this cloud of not having yet agreed a trade deal. So it's still very difficult, really, to sort of see any sort of bright lining for these equity markets. I think for Japan in particular, I think Ishiba-san had wanted to get a trade deal. With that, he could have gone to the public and recognized the fact that a lot of the uncertainty had been removed, and then you would have been able to see the central bank go back and start to raise rates to quell some of the inflation. So unfortunately, they're still in this sort of vicious cycle in which there's no trade deal, inflation continues to rise, and that's making the population unhappy. So I guess in the short term, he's going to have to make perhaps some concessions in terms of tax relief to, again, provide some stimulus to the economy, and then hope that there's a trade deal in the background that can be signed for him to perhaps go back and seek a second election. So he's still in that spiral in which the trade deal really is the core issue in terms of being able to go back to the public and hopefully get a better election outcome than perhaps the one that's just happened.
Well, Bloomberg, as you may have heard, has been speaking to Kyle Bass of Heyman Capital. He's long had views on Japan. He's had some views on the yen as well. Let's take a quick listen.
Japanese sovereign debt to GDP is north of 260%. It's kind of the world's most interesting debt laboratory. I think they're in a precarious position, i.e. they either have to let their currency go or their bond market go, and they'll never let their bond market go. So I would beware of the yen into the future.
So, Sean, with that in mind, what's your view on where the floor could be for the yen?
Well, I'm not necessarily the currency expert for Mizuho, but I would slightly take issue with Mr. Bass's comments on the instability of Japan's bond market. I think you have to look at the other side of the balance sheet, and Japan has been running record current account surpluses. Its savings surpluses are huge, and there's no difficulty in Japan being able to finance its debt. So that, I think, is not an issue for Japan, nor necessarily the yen. Yes, Japan's got a large debt to GDP ratio, but it's all that debt is in yen, and they're running very, very large savings surpluses. I think at the end of last year, the current account was the largest in history for Japan as well as for China. So I think in the short term, I think markets are probably not going to be that concerned with the level of debt. I think what really matters in Japan at the moment is getting the inflation normalized and getting essentially the central bank being able to start to use monetary policy again to quell some of that inflation. So I'm less concerned than Mr. Bass on the outcome for the yen and for Japan's debt markets.
I think we have really been focusing on the debt markets just because of the performance of previous auctions when it comes to the ultra long here in Japan, right? I mean, we have seen the BOJ perhaps pulling back some of those reductions of purchases that we've seen. The finance ministry has been talking about the auctions as well. When it comes to these yields that continue to surge in the long end to 2-decade highs, at what point does it become a problem for the stock market?
That's a good question. I think at the moment it has been less of an issue for the Japanese equity market, principally because real interest rates, both at the short end and to some extent at the long end, if you look at inflation swaps, have been negative. So with real rates negative, you tend to find that equity markets tend to be well supported. So the move in yields has not come about with such a vicious force that it's created a downward spiral in asset markets, as you would have seen perhaps in Europe in 2011 or in the UK bond markets a couple of years ago. So far, you haven't had that spillover effect harming Japanese equities. You also have to bear in mind that there's a lot of companies or a lot of financials in Japan that tend to benefit from a steepening of the yield curve. And again, Japan has quite a large weighting of banks in its indices, which means that, again, it's not as adversely hit by a higher long-term rate. So provided real rates remain relatively negative where we are at the moment, I'm not so sure we're going to get the very bad spillover effects harming Japanese equities or North Asian equities in the same manner.
Also, I guess, Sean, is a period of time right now when we're seeing the stock markets look for any excuse to continue its trajectory upwards, right? We do have earnings season in the mix. We are going to get the likes of tech giants reporting Alphabet this week as well. When it comes to that semiconductor cycle, when it comes to that tech cycle here in Asia, how durable has it been, and can it continue to be this resilient?
That's a really good question. I think the way I would look at it at the moment is that, ironically, the OBA, or One Big Beautiful Bill Act that Mr. Trump got signed off a week or so ago, actually encouraged front-loading of investment, particularly into data centers and also into tech equipment. He's allowed purchasers of equipment to write that off within 1 year or depreciate it by 100%. That's an enormous incentive to go out and spend on tech equipment, everything from servers all the way down to PC peripherals. So ironically, for Asia, we're going to get an added boost from those measures coming through. And as I said, I think it's going to be still relatively good news for the tech industry in Taiwan and Korea. And certainly when we've looked at the PMI for Taiwan, for electronics, it's remained in an expansion phase for the best part of this year, and as well as backlog of orders as well have also remained firm. So I don't think we're going to see any bad earnings numbers necessarily from the US tech or from Asia tech for the next quarter or so.
Sean, I just want to get your views on what we're seeing in the commodity space as well. We've got iron ore right now, the most active traded contract in Singapore. Copper's hovering around a 2-year high, and silver's been the quiet bolter of the year as well. How sustainable are some of these gains?
That's also a good question. I think the commodity equity class has been very under-owned. It's been a very big underperformer after the big boost from post-COVID. From my perspective, the whole electricity and grid electrification theme is going to underwrite the copper and aluminium metal prices, and certainly the evidence that we're seeing from the build-out of the dam in Tibet, as well as also the infrastructure that's going on in the United States for nuclear power, is going to be very, very bullish for those copper and aluminium metal prices. But overall, if you look at the commodity indices, they should be actually doing a lot better were it not for the weakness in oil prices. Food prices remain very elevated compared to where we've been in history, and as I've alluded to in the metal markets, the fiscal stimulus that's come through from the United States and in China over the last 12 months is going to be very bullish for fixed asset investment. So I would expect with the weak dollar and fiscal expenditure that metal prices can hold their gains and probably do pretty well for the rest of the year.
Yeah, the Bloomberg Commodity Index up for 3 consecutive weeks already. Sean Darby, always good to have you with us, Managing Director at Mizuho Securities Asia.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.